Hi everyone. Welcome to our group presentation on investment management in personal financial planning. Today, managing your money wisely isn't just about saving, but it's about planning your finance in a way that help you grow your wealth and achieve your goals. So, what is personal financial planning? It's actually a process of managing your money to meet your financial goals. So why it is important? Because without proper financial planning and investment, your money loses value over time due to inflation and your financial goals may stay out of reach. It also do help in control spending, saving money for future needs and make investment. So, talking about investment, in this video, we will guide you through the key part of what investment management actually means, then moving into goals, risk profile, diversification strategies, useful investing platform, and finally, some common mistakes to avoid. Here we begin with the first segment, which is what is investment management. Investment management is process of managing financial asset and other investment. It's also important because first, it helps grow wealth over time. Smart asset allocation ensure your investment steadily appreciate and build wealth. Second, manage risk through diversification. For example, spreading assets across different type of investment could lower the unsystematic risk. Lastly, help achieve financial goals. You could customize strategies align investment with your specific goals.
Hi, my name is Michelle. So today I will be explaining types of investment, return of investment, and also risk of investment. So let's begin. Investment management involves the process of choosing the right types of investment based on one's financial goals and the level of risk one is prepared to accept. Among the various options available, the following three types are the most popular in the current financial market. So first, we have stocks, where investors buy a small part of a company. If the company perform well, they may earn profit. For example, buying Tesla shares at RM200 and later selling them at RM1000 give a capital gain of RM300. Second is cryptocurrency. It's like Bitcoin. This is a digital currency that is highly risky due to rapid price changes but can offer higher returns. For instance, buying Bitcoin at 90,000 and selling at 120,000 will result in a 30,000 profit. Lastly, there is real estate, which involves buying property. For example, purchasing an apartment in Kuala Lumpur and renting it out for 1,200 a month provide a steady stream of income. So how do we know if an investment is actually profitable? That's where return of investment or ROI comes in. ROI is a simple and useful way to measure how much profit is made compared to how much was invested. Here is the basic formula. ROI equal to gain divided by cost times 100%. It gives us the return as a percentage, making it easier to compare different investments. So now, let's take a look at a quick example to understand how ROI works in real life. So here is the question. Eileen decided to invest her savings by purchasing 100 shares of a company at RM10 each, amounting a total investment of 1,000. After 6 months, the share price increased to RM13 per shares and she sells all her shares. Additionally, she received a dividend of RM50 per share during the holding period. So what is Eileen's total return of investment? So this is the solution. First, we calculate the capital gain. Selling price equal to 13 times 100, we get 1,200, and buying price equal to 10 ringgit times 100, we get 1,000. So the capital gain is equal to selling price minus buying price, which is 1,300 minus 1,000, we get 300. Next, we calculate the dividend income, which is RM50 times 100 shares, we get 50. So the total gain is equal to capital gain plus dividend income, which is 300 plus 50 equal to 350. Now we apply the ROI formula, which is ROI equal to gain divide by cost times 100. So 350 divide by 1000 times 100%, we get 35%. This means the investor or Eileen earn a 35% return on their investment. Well, that sounds like a great return, right? But as we know, nothing is perfect. So all investment come with risk, and understanding this risk is just as important as understanding returns. So let's look at some common types of investment risk. First one is market risk. Price may go up and down due to market conditions. For example, during the COVID-19 pandemic, many stock prices dropped significantly. Next is inflation risk. Over time, the value of money decreases due to rising prices. So if the investment return is lower than inflation, the real value of money will go down. Lastly is credit risk. So this is the risk of the borrower failing to repay the investment. For example, if a company goes bankrupt and cannot repay its bonds, the investor may lose money. So that's all from me.
Hi, I am Maunia Frina, and firstly, I will be presenting about investment objective. Investment objective refer to what investors aim to achieve and vary based on age, income level, and future needs. The three main types are capital preservation, that focus protecting the initial investment. It is suitable for risk-averse individuals like retirees, as example, saving accounts, fixed deposits, or ASB. Besides, income generation aims to provide regular income through dividends or rents. It is ideal for those needing steady cash flow, such as pensioners or part-time workers. Lastly, capital growth. It seeks to grow wealth over time and suitable for long-term investors such as stocks and mutual funds. These objectives help investors choose the right investment strategy that suits their needs and comfort level. Once goals are clear, the next step is to assess how much risk an investor can take. This is called as risk profiling. Risk profiling assesses how much risk a person can handle financially and emotionally. Firstly, conservative investors have a low tolerance for risk and prefer stable and predictable returns. Suitable options for conservative investors include bonds, saving accounts, and money market funds. Next, moderate investors are open to taking on some level of risk in exchange for moderate returns. They usually invest for medium to long-term goals such as balanced funds or mixed portfolios. Other than that, aggressive investors are comfortable with high levels of risk and aim for maximum returns over the long term. They are willing to take bigger risks in hopes of higher rewards, as example, stocks and cryptocurrencies. Next, understanding investment and risk is especially important in the Malaysian context. According to Bank Negara Malaysia, many households lack emergency savings and are not ready for retirement. Fear and lack of knowledge often keep people from investing. However, younger Malaysians are increasingly open learning and investing through platforms like Touch 'n Go Go Plus, Wahid Invest, and Bursa Marketplace.
Hi everyone, my name is Alia Fazira binti Muhammad Nasir. So today we're going to talk about asset allocation and diversification. What is asset allocation? Asset allocation refers to how you divide your money across different types of investment such as bonds, stocks, property, or even a gold. Next is diversification. What is diversification? Diversification means spreading your investment in poor performance in one area doesn't severely affect or impact your entire portfolio. So we can take example from life event. My uncle, he invested in stocks for growth, property for steady income, and ASB for safety. When the stock market dipped last year, his property and ASB returns kept his portfolio stable. That's the power of diversification. Next is general practice of Malaysian household. Many Malaysian households rely heavily on EPF, which is KWSP and ASB, as the main investment tools. They prefer low-risk investment due to limited financial literacy, and they are often unaware of the importance of diversifying beyond savings and unit trusts. Lastly, sample asset allocation strategy. First is a stock. 140% in stocks. As a young investor, you have time to ride out market ups and downs. Stocks offer a high growth potential, and you can invest it for a long-term investment. Secondly, bonds. Bonds are like a steady friend in your portfolio. They provide a fixed income with a low risk. In Malaysia, You could consider government bonds or even a corporate bonds. Other than that, it's property. Property isn't just about buying a house. It could be a capital appreciation plus rental income. Next is a gold. Gold is your safety net. It hedges against inflation and ringgit volatility. You don't need a physical gold. You can buy it online. Lastly, cash or saving. Always keep your cash for emergencies such as medical bills or even when you lost your job. At least you have your saving to keep you survive. And aim for 3 or 6 months of living expense.
So now let's move to tools and platforms for investing. Due to the quick development of online tools and platforms, investing is now easier than ever in the current digital era. Now I will describe the main types of investment platforms and tools that are frequently utilized in personal financial planning. Firstly, there's brokerage platforms. So, brokerage platform offers access to stocks, ETFs, and bonds. It offers advanced features like limit orders, margin trading, and research tools. Examples of brokerage platforms are Fidelity, Robinhood, Rakuten Trade. Next, we have robo-advisors. This is an automated portfolio management based on goals and risk. There is a low fees and easy to set up for passive investors. Examples of this are StashAway and Wahid. Next, we also have mobile investment apps. So, using mobile investment apps, we can invest on the go with easy interfaces. And you can often integrate with e-wallets or bank accounts for smooth fund transfers. Examples are Rise, Touch and Go, Touch and Go. Then we also have alternative investment platforms like crypto, real estate, P2P lending. This helps diversify beyond traditional assets to hedge against market volatility. Examples are Binance, Real Vantage, and funding societies.
So, as we come to the conclusion of our presentation, we've come to realize that personal financial planning is not just about saving money, but it's about having a structured plan to achieve our financial goals through smart investment decisions. From the assignment, we explored how investment management plays a critical role in personal finance. It's not only about putting your money somewhere and hoping it grows, but it involves setting clear financial goals, understanding your risk profile, choosing suitable asset classes like stocks, cryptocurrency, or real estate, and using key metrics like return on investment (ROI) to measure performance. For example, as shown in our ROI case study, even a basic investment in company shares can provide meaningful returns when calculated properly, including capital gains and dividends. This shows the importance of knowing not just what to invest in, but also how to evaluate its success. One of the most insightful parts was learning about risk profiling, understanding whether you are a conservative, moderate, or aggressive investor. This helps in aligning your portfolio with your comfort level and financial timeline. We also touched on the reality of financial behavior in Malaysia. Many Malaysians, as reported by Bank Negara, are still financially unprepared for emergencies or retirement. Fear and lack of knowledge are major barriers to investing. However, it's encouraging to see younger Malaysians taking interest through platforms like Touch and Go, Go Plus, and Wahid Investment. Digital tools and mobile apps have made investing more accessible than ever. You don't need to be rich or a finance expert to get started. With resources like robo-advisors and mobile investment apps, the playing field is more open than before. In short, this topic has taught us that successfully investing requires more than luck. It requires knowledge, planning, self-awareness, and discipline. Our biggest takeaway: start small, start early, and stay informed. Investing wisely today can shape the kind of future we want tomorrow. Thank you.